Hello friends, welcome to the second session of Advanced Financial Modeling. The name of this session is Financial Model Components. In this session, I will take you to a real financial model, a sample one, and show you that what are the different components of the financial model, what is the significance of those components, and what we are going to what we calculate those, how we calculate all those components, what are the functions of it. In the first model, in the first slide, in the first session, we shared you guys about the basics of financial modeling and how it is done. And I hope you guys have done some research on it and definitely got some basic knowledge clear. Now, in this session, also, a lot of other knowledge will be clear to you all, you guys. So, let's see the sample financial model here. So, this is a sample financial model. Right? It got prepared in Google Sheets. You can prepare the sample financial model in MS Excel also. Functions are always almost same. So in the sample financial model, the first page of the model is all about the basic inputs, the case problem statement. Whatever inputs you get from the client, you put in the first page of financial model. Okay, so here also it's put the first page of financial model that a guy want to buy a flat of about 1 crore rupees with a debt equity ratio of 70-30%, and we want to pay back the loan of 70 lakh rupees through the rent he get from the flat. It's a not it's a very simple financial model, but considering it as a non-recourse debt project finance, because the collateral of the finance is the flat itself, we can go ahead and check what all is needed to be in that financial modeling. Usually the financial model can have a lot of sheets, not only cost, revenue, fin flow. Fin flow sheets means cash flow sheets, fin flow, financial flow sheets, whatever you can talk about, and the debt repayment sheet. So let's talk about the cost sheet. So here you can see the capex and opex are mentioned. The capex, the rate of the capex, and a lot of capex got breakdown, right? Flat, interior decoration, furniture, fixtures, building, broker fees, stamp duty, and all these things. O&M also got breakup. Now the first question is, what if for any project, any infrastructure project, you got the capex and opex, but you don't know how to break it up, right? So what amount need to be paid for what purpose, and who is gonna get the amount? What if you don't know the breakup? Then, so the suggestion here is, even if you know the breakup, even if you don't know the breakup, it is not going to change much in the financial model. Okay, so a lot of time the financial analyst got the breakup in a very delayed time, right? Not in the beginning, so in the later stage. So in the beginning stage, even if you know the capex and opex, that is more than enough to initiate the financial modeling. Later on, when you know what is the breakup of the cost, you can add in the financial modeling. Okay, so this is the cost, opex and capex. As the name suggests, capital expenditure is the project cost, and operational O&M is the operational expenditure. Let's talk about the revenue. Now here in this case, the city is Mumbai. The area of the flat is 3000 square feet, is a big flat. Average occupancy months. Now try to understand that why we take average occupancy, or why we take like this. So whenever you make a model and show it to the bank always tend to find out mistakes in terms of revenue. What kind of mistake the bank want to find out is, like, it might be possibly you have taken a revenue as a very higher number. You have not taken a real case scenario, you have taken a best case scenario, and that is not fair as per the bank. They think that it's not fair. You cannot just take the whole scenario as a best case. You need to take a real case. So best case is yes, you can have the rent always ready for next 5 years every time your flat is booked, but it's not real, right? Real case, your flat cannot be booked for 5 years every single month. It might be possible 6 months it's not booked, then 2 years is booked. Sometimes you need to pay some broker fee, sometimes you don't need to pay from broker fee. So to incorporate all those things, you need to take an average occupancy. Okay. Now rent is 250,000, like 2.5 lakhs per month. Deposit is 4 months. Deposit is when you take a rent in Mumbai in a big flat, you need to pay deposit, right, for 4 months. Okay. And then this is written in a bracket, 1/3 of the annual rent. Sometimes 4 months is deposit is applicable when the guy is staying in this apartment for 12 months. If somebody stayed in 10 months only, or maybe 6 months, then 1/3 of that rent is should be taken as deposit. Now interest on the rental deposit 8%, rent appreciation 5%, 5% of the rent got appreciated. Now what happened that why interest on rental deposit? Because bank will say that if you are taking the deposit and paying back to them after 2 years or 1 year, so that rent deposit what you are getting, no matter even if you put that in fixed deposit or not, but as per the bank is concerned, you are getting an interest on that deposit. So you need to add in your revenue. So all those revenue things are pretty much clear that how they have calculated this revenue. Okay, all this revenue, see the formulas are here and interest formulas are here. It's pretty much clear. Okay, if somebody have a doubt in this revenue calculation, you can ask me separately. So they find out the revenue in million rupees every year, yearly basis. So for these are the years and these are the revenue. Now the finance flows, fin flows, cash flows sheet or something. When you look at the sheet like this, it look like a little bit complex, right? But let me explain you one by one basis. It is not so much complex. It look like complex. This first box is the project details. Details about the square foot. This is the total amount of the cost. Equity 30%, debt 70%. Debt service reserve 0.25 years means 3 months of the rent should be reserved in the debt service account. You cannot withdraw any money until unless 3 months of the rent is there. Okay. Now let's talk about the assumptions. Assumptions are those things which you didn't get from your client. That you need to calculate the assumptions from the banks. So from the banks, from the internet, from the Reserve Bank of India. So all those are the assumptions that is applicable to this model. Assumption is also location based, like what you assume in setting up something in India, and you cannot assume same thing in setting something in Singapore. So assumption is also based on the location. Here the assumption inflation rate 4%. DDT is dividend distribution tax 0% I have taken, but yes, tax holiday is there is any holiday from the government. Tax rate 25% is the corporate tax rate, it is called. Debt rate means the interest rate on the debt. Next is moratorium period. A lot of guys got confused what is moratorium. What happened that whenever you take loan from the bank, okay, the bank is there to make money, calculations. So the day you withdraw the money from the bank starts charging interest from the next day. Okay, from the next day the interest is getting charged. Now what happened that, so and that is not it is undeniable. You need to pay that interest. That is for sure. But you can request the bank in terms of non-recourse debt or project finance. Ki, sir, you are charging me interest. That is fine, but we cannot pay you back this interest or the principal amount until unless my project is getting ready. And it takes 6 months to get the project ready, or maybe 1 year to get the project ready. So the bank say, okay, what do you want to say? What do you want to suggest? You say, sir, can I take a moratorium of 6 months and we will not pay you back the principal in first 6 months, and then I will start paying back the principal? The bank will say, okay, fine, no problem. Pay me the interest. Principal you can pay me back later on also after 6 months. That time is called moratorium in a simple terms. Debt tenure is the time period for which you took the loan. Depreciation of 7%. Depreciation is something that is depends upon a lot of things, right? Which for infrastructure project, what is the depreciation? For electronics goods, what is the depreciation? There are a lot of things are involved in this depreciation thing. But here we have taken an average of 7% as depreciation. Okay, the overall project. Then some assumptions like USD INR assumption, discount rate 10%. What is this discount rate? Discount rate 10% means the rate at which there is an alternative investment is ready. Secured alternative investment. So suppose if I come to you and tell you that I have a project where you get an internal rate of return of 15%, and that guy say, but we are discounting the rate of return as 10%, means if we don't invest in you, we are already getting payment at 10% in other investment. So that is called discount rate. Sometimes this discount rate got used, sometimes it doesn't get used, but yes, it should be here in the assumptions. Construction time in this case is about 3-4 months. MAT is minimum alternate tax, 18.5%. It keep on changing. Okay. So now before we hit this button, let's talk about this. These blocks are very simple to understand. Let's check for 1 year, right? The first block is revenue. Total revenue you need to write. Then total operating expense. Revenue minus operating expense is EBITDA. Earning before interest, tax, depreciation and amortization. This is the EBITDA. The revenue minus operating expense. Now from this EBITDA, you need to subtract the interest payment and the depreciation. Okay. Depreciation is non-cash expense. You need to separate that. Now that is the total non-operating expense, the non-cash expense. Now, when you subtract that EBITDA minus this non-operating expense, then you get the net income, right? Income before tax and then net income. Okay, so this is the net income what you have. Then you need to add back the depreciation what you already subtracted here, because depreciation is not the amount you actually spent, right? And then you need to subtract the principal payment, interest you already paid here on your debt, then the principal. CSR, right? Corporate social responsibility. Sometimes it is 0.5%, sometimes 1%, sometimes 0. It depends upon the project and it depends upon how much is the bank is pushing you to put. So we have put 0.5% here. It's not a fixed number. So total project cash flow, final project cash flow is this much. This is the project equity amount and this is the cash flow. So now this is a negative investment, negative equity, like as an equity investor you have invested this much, and these are the inflows, the money coming into you. So when you do the calculation here and put that in this XIRR function, you will get the equity IRR percentage. Okay. Same like with the project cash flow also. This is the project total project cash flow, and these are the cash flow in the project, and you can get the project IRR. Now DSCR, like it's simple to understand DSCR, that how much cash you have and how much you need to pay the debt. So when you do the ratio, you can calculate this DSCR numbers. Okay. You need to mention minimum DSCR and average DSCR. Okay. So when you do for 1 year, you can keep on continuing for 25 years because the life cycle of the project take 25 years. But sometimes it's not required to do 25 years. It can be done for 15 years also. It depends upon the project, depends upon the life cycle. Now, this is the today date and this is the COD. Okay. COD means commercial operation date. So these two dates also very much need to mention, because after the commercial operation date is the date when the expense is already done. After the COD, the project should throw cash back. That's why COD is very important. In this whole sheet, you have seen two numbers that just pop up from somewhere. That is interest payment and the principal payment. Now let's see that how this interest and principal payment is calculated. In this sheet, this is the block that you need to focus on first. Debt amount, debt rate, moratorium, term, payment periods. Payment period is 1 quarter. Sometimes somebody says one period as a 1 month. Here we have taken payment period as 1 quarter. So again you use the PPMT, PMT and IPMT function and calculate this debt repayment. And then since here it's one period is 3 months, but in FinFlows our earned period is 1 year, right? So we need to combine these things and put in here as every year how much you are paying. Now let's see in the first period, which is 0. Interest payment is this much, total amount this balance is this much, but this interest is not paid. This interest is not paid through the revenue. This interest is paid through the cash capex, right? So that's why we didn't put this interest payment in our financial FinFlow sheets. So you can see that the financial model is quite mathematical and quite clear in picture. There's nothing hidden rule in the financial model, right? It's same like if you calculate the cost, if you calculate the revenue, then calculating the FinFlows, the cash flow sheet is simple, and then calculating the debt is also very simple. In the next session, I'm going to tell you how to prepare financial model. Okay, but in this session, try to understand that whatever written in this financial model, try to understand each and every function. If you don't understand any function, you can ask us. We will definitely clarify you, but it's not so difficult. That is what my point is. It's not so difficult. You can understand the functions and you can prepare the financial model by yourself. Okay guys, take care of yourself. Thank you.